Good afternoon, everybody. Welcome to your Trader Merlin show. It is your Friday weekend edition. I only made one mistake today. One mistake, and that is I did not bring a glass of whiskey upstairs for me for the show, which means when I wrap up today's show, I'll have to make up for it because look forward to a good weekend. Hope you had a great trading day out there. Yeah, the action today was not the best. Whipsaw back and forth, lots of chopping. You can tell right away just by looking at the daily candle, the S&P. You've got long bottoming tail, long topping tail, and really not much direction. We were only down 0.15% on the S&P for the day, 0.32 for the NASDAQ. And we'll look at more of that as we progress. But I want to dive into the topic du jour and get as much time with our guest as possible. As you guys know, I affectionately refer to this guy as the Bond King because he's taught me more about bonds than all of my collegiate experience combined times 1,000. I thought my college experience was an absolute waste of time with regards to learning about financial markets. And if you spend an hour or two with this guy, as many of you have on this program, you understand the amount of experience and what experience does to help you understand asset classes. I'm talking about none other than Mr. Bill Addiss, talking about our bond market update for today. Bill, hailing from the East Coast today. Hope you're doing well. How you been, my friend?
I am doing great. It is beautiful outside Washington, D.C. Good day to be home. So pleasure to be with you in the audience.
Yes,
That's quite an intro. Thank you, sir. Always love working with you guys.
It's well deserved. You know, look, I'm the small little gut, as Mongo said in Blazing Saddles. Mongo just pawn in Game of Life. I feel like I'm that little pawn in the game of life too. And every now and again, you get to run across people that really like change your perspective of asset classes and really make you understand things, whether it's financial markets or anything else in life. And you'd certainly have done that from day one, which is why I love having you on every 6-8 weeks just to talk about bonds, what the updates are. So I appreciate you very much, as my audience does as well. Let's dive into the boredom. So
yeah, right.
I tweeted out right before the announcement. I said, here's what's going to happen. He's going to not cut rates. He's going to say he's data dependent. He's going to cite the issues with Israel and Iran. He's going to cite the tariff issue. He'll say he's data dependent. He will say positive things about inflation. He'll say positive things about unemployment and be concerned about GDP. And it was like trifecta across the board for every single one of those things.
You're a speechwriter.
I should have been a speechwriter, but all in all, you kind of have a little bit of a snooze fest. So maybe you can talk to some of the changes that might have been under the hood, or your thoughts on just the changes that were made.
Yeah, no, and exactly as you said, the announcement itself was a bore, and we knew it was going to be a bore. The market was pricing in 90-plus probability that there was going to be no change in rates this meeting. So that was not what people were waiting for. What people were waiting for was the dot plots in the press conference, because we got the update to the plots. Mm-hmm. And, quite honestly, this is the times where Powell has been known to kind of go off script a little bit when he gets hit with the more extemporaneous things that he has to address. And there was not even any of that.
None.
He was really watching his adjectives and adverbs. And he played it, I want to say like a good politician, but that gives a different implication.
Yeah, it is political. It is very political.
It is, absolutely. Absolutely. There are changes to the dot plots, and that is really the only significance, is the Fed's getting a little bit more pessimistic. But if you read into that pessimism and, what they were calling for in terms of, the GDP being down a little bit from 1.7 down to 1.4, unemployment going up to 4.5. I mean, if you were to just read the dot plots, you'd think, where's the cut?
Yeah.
We should have a cut based on this data.
And I have it up here for you. Okay. I have the dot plot up here as we speak. So,
cool.
I brought this one up the other day because it's relatively interesting. And personally, I was telling my audience that, on this dot plot, I've got 2025, 2026, 2027, and then the longer run. Look, take everything from 2027 and just put a white piece of paper over it. That means absolutely nothing. It means, that's all hopes, dreams, and wishes. It's like me saying I'm going to be a rocket scientist and have my pilot license by 2027. You don't ever know what the future's going to hold. So erase 2027 and on. What is noteworthy for 2025, you can see that initially on this dot plot, only 4 members thought we were going to keep rates right where they're at, which is 4.5 to 4.25. That is actually up from 4 to 7 members. Previously, there was 4 members thinking we're going to have 1 rate cut. Now there was 2 members thinking we're going to have 1 rate cut. And before you had more members thinking 2 rate cuts, now it's fewer. So this certainly looks a little bit more hawkish in the sense of fewer rate cuts going forward, correct?
Right. Exactly. Yeah. And I remind you, you remember last year when we were looking for 8 rate cuts?
Yeah. Oh man, that was so funny. And we were both
2024.
laughing at that, by the way. Just to be
Yes,
fair, we were
exactly.
both going, "Come on, no
Yep.
way, 8 rate cuts."
Yeah. No, the Fed, here's my read of the situation, honestly, is, the tariff situation is really what's hanging over this market. And this is a potential game changer. Let's be honest. We don't know the impact of that. And I really do think, whereas the Fed started on a cautious note, having nothing to do with tariffs. Remember when we started this, a year ago, the wait and see, this was all pre-tariffs and pre-election.
Yeah.
But I do think the tariff situation has really put a hand grenade into the market because number one, we don't really know the impact of the tariffs. We don't understand the inflationary implications. But more importantly, it's something that's not in their modeling.
Hmm.
The Fed really is data driven. And when you get groundbreaking changes, it's not in the modeling. I'm going back to the time when, Arthur pre-Volcker days with Arthur Burns when they tried cost controls. Remember under Nixon, they tried the cost controls where they couldn't raise prices, and ultimately they had to pull that off because things naturally did want to rise. You can't manipulate the market down like that, and we had all that pent up pricing increases that led to the huge inflationary spirals 2 years later. And I think the Fed's kind of worried about that. They
Yeah.
don't want to look back and say we blew it. Right before something that was potentially, and I'll stress the word potentially, inflationary, the Fed dropped rates.
Yeah.
And I don't think they want to be looked at that way. But I agree with your observation. If you look at the comments that are made, the forecasts that are made, A plus B equals C, it should equal a cut. I really don't think they want to cut before we understand what the implications of the tariff are.
You
He doesn't
know,
want that to be his legacy.
yeah, I agree. And you know what? I guess one of the concerns I have is this desire to constantly point the finger at something, and it's like, okay, well, we're data dependent, and I don't think there's anybody in the audience that would say, okay, well, that doesn't make sense. Of course, it makes sense to be data dependent, but now the data is showing better and better and better numbers. For the viewers, I'll bring up my scorecard here. I think I have it all ready to go. Here's my scorecard. This is something that I've been keeping track of, just because you talk about the pieces of data that the Fed is supposed to be looking at, and that's what they're making the decisions off of. I have CPI, PPI, PCE, core price index, and unemployment, and technically those are supposed to be the variables. And we know it's not CPI or PPI; it's really PCE. And
Right.
since April, all of those numbers, consumer price index has been negative 0.1, 0.3, and 0.1. PPI is negative 0.4, negative 0.5, and latest reading was 0.1. Core PCE, 0. Next in May was 0.1. Next week we will get our next core PCE number, and unemployment stuck at 4.2%. So if you're data driven and data dependent, all things right now are pointing that you should be lowering rates because that is your job, is to make sure these things aren't out of control. Right now they seem to be in control, but we're getting that finger pointing to tariffs, which I totally understand. Of course, the uncertainty that Israel and Iran conflict brings. Does the U.S. get involved? Who else gets involved? But you're going to keep pointing fingers at something. At what point do you finally say, okay, fine, we'll stop making excuses and cut and let this market rip?
I think the answer to that would be if the data were, in fact, strongly convincing one way or the other. I think the marketplace would almost force them to have to do a cut. If it gets. But right now, we have to admit, and I'll be the first to admit, I am more optimistic in the last month on our economy than I've been in years, I think. You talked about the good CPI number, the good PPI number. The PC numbers have all been good. The last week we had incredible demand for the 10 and 30-year treasuries, much to everybody's surprise.
Yeah.
There's really some interesting good things coming on. I will admit, I tend to focus more on the bearish side. I'm one of those bond vigilantes. I like seeing rates go up more than I like seeing them go down, I admit, I think. But we've got a compelling case going here. But I just think the Fed is too concerned about dropping the ball right in front of the tariffs. And the problem with that, obviously, is this tariff situation could go on for months.
Yes.
I mean, U.S. and China aren't even meeting for another 2 weeks. Talk about, things taking a long time to be implemented. And the market doesn't like that. And I don't think the Fed wants to be accused of doing the wrong thing right in front of the tariff implementation.
I think that the vast majority of the world should look at that and go, how freaking pathetic is it that on an issue that is so critical to global business on both sides that you have to wait 2 weeks to have a meeting? Like, what else is on the plate of these people? So they go, oh, I can't meet for 2 weeks on the most important issue to face my economy in the last 20 years.
Exactly.
Absolutely ridiculous.
And as we all know, no matter what asset category you're trading, the market doesn't like uncertainty. And we're really in this limbo situation. So, forgive me for saying it, but for President Trump to say, I want you to cut rates, but I'm not giving you anything definitive yet as to what to work with in terms of tariffs, it's unfair. You can't have your cake and eat it too. Give us a definitive plan. Then we can work around it. Give us some definitive numbers, then we can work around it.
Yeah, I like this. Louis says a really funny comment. He says, wouldn't it be nice if we could just call our mortgage companies and tell them lower rates because I want to pay less? Isn't that what Trump's doing?
Exactly.
Yeah, in a way, it absolutely is going that way. So let's revisit. I'm going to bring up the 10-year chart here. So here's the yield on that 10-year bond. And I've been very bullish on the yield. I was just of the opinion that the uncertainty facing America, the uncertainty facing the trade tariffs, the let's just say negative perception of the United States on the global stage because of the aggressive political actions by the president would have caused people to be less motivated to buy 10-year bonds. Therefore, we lose buyers and maybe even sell their bonds they do own. And I was really expecting to see the yield spike more. Really since, I'll just put the cursor at the peak here, since mid to late May, when we peaked out on that 10-year yield at 4.62, here we are drifting slowly lower. As of today, right now, we're at 4.377, but the trend looks good from April, but really not that exciting. Where's your, your veteran hypothesis of this?
Yeah. And even the intraday volatility has slowed up considerably. After that April debacle where we had such interest rate debacle and bond market debacle, the volatility has lessened considerably. But I'm going to express the same surprise you are because, like you, the last two times we've been together, I've said that I think we're going to hit 5% on the 10-year before we hit 4%. And I'm still inclined to be that way, but I'm not going to lie, with much less conviction. Because what I'm really surprised by is the demand for U.S. Treasuries. I mean, these auctions we had 2 weeks ago were just not the cover off the ball good. Out of the 10-year, 87% of that 10-year Treasury went to foreign investors. Foreign investors are stepping up to buy U.S. dollars. I'm not sure I understand why, I'll be honest with you. But we had a bid to cover ratio of 2.63 versus our average of 2.5%. The dealers wound up taking hardly any inventory, and they're kind of the ones who have to pick up the pieces if nobody else buys it. And they didn't have to commit a lot of capital. I have to say, in spite of everything going on, we are seeing strong demand for dollar-denominated assets, and specifically U.S. Treasuries. The 30-year also had record numbers for it. Both auctions came out 2 basis points lower than we expected them, a lower yield than we expected, reflecting such strong demand.
Right.
So, yeah, exactly. And again, between some good economic numbers on the inflation front, strong demand for treasuries, I'm a bit more optimistic. So I'm still putting my foot in my mouth and saying 5% before 4%. But I have to admit, I don't have as much conviction about it as I too had back in May.
Guys, it's 2:14 p.m. Pacific time, June 20th, 2025. Mark your calendars. Bill Addiss just admitted to being optimistic. I am writing this one down.
I know. Prozac must have kicked in. Somebody
I'm
must
just checking. Did the clouds stop moving? Like what?
Right, exactly. No, I'm as surprised as anybody. I will admit it, and I almost don't feel comfortable in my own skin. What do you mean I'm starting to get positive about this? But I too, I guess I'm data determinant, data dependent,
as we should be.
The numbers are coming in pretty good. Yeah, exactly.
And this is something I try to emphasize as well to my audience is in the beginning of the year, especially as we went into the April announcements, I was very bearish, and I, in my opinion, if this continued on. More downside movement. And we saw some resolution happen right away. And this is the beauty of being a trader or an investor is the ability for you to say, well, I was thinking this, but you know what? the data has led me, in my case, the price charts and data have led me to change my tune. And, I'm long, I'm bullish, and great. I'm happy to flip my direction. So it's okay. I like giving you a hard time for being optimistic, but it's all right to change your mind.
It doesn't happen often. I don't blame you at all. I'm one of those vigilantes. I admit it. But even that strength is being expressed in the short end of the market. We've got a real blip in the yield curve right now. That 1 month T-bill that I've been advocating for, the T-bill roll that's worked so effectively for a year.
Yep.
Once Iran and Israel started lobbing missiles back and forth, we experienced last week the traditional flight to safety. Investors, once again, we saw strong demand for treasuries in that global uncertainty. The 1 month T-bill right now is yielding 35 basis points less than the 2 month T-bill.
Yeah.
That's crazy. But what that reflects is globally, investors are rushing to the safety of U.S. treasuries in times of global uncertainty, even though we're one of the involved parties. That doesn't seem to matter. So I do caution people. The 1 month T-bill right now, the yield is abysmally low. We're barely over 4%. If people are doing that ladder, they might want to think about going out to 2 months where you'll pick up an extra 35 basis points. But what's interesting about this is this flight to safety phenomenon is very common.
Yeah.
But it's never as long lasting as this is. Normally we react to the news, you get that surge of demand, yields go down, and then within 2 or 3 days, things kind of readjust. We're now going into our second week of this aberration as Israel and Iraq keep lobbing missiles back and forth. And now, again, the topic of the president delaying decisions, this too could drag out for another 2 months, which means maybe that this aberration is going to stay longer.
Yeah.
But I'm offering a cautionary note to the real short maturities that I've been so favorable to. The yields are distortedly low.
Yeah.
So be careful.
When you look at that, I had the yield curve up there, and that's actually from TradingView. There's a really cool feature there, right? It shows the yield curve, and I have it as of June 3rd and 2025 and 2024. When you look at that chart, especially the dark blue one there, which is the current one, I know you can't see it, Bill, but
that's right.
You could go out, and your 3 month right now is going to be getting you 4.35, whereas a 3 year is going to be getting me 3.8. So I just wonder, why on earth would anyone want to buy that 3 year, knowing that you're inverted so much? And even if you didn't want to go the short term and get that 4.3, I could jump out and go maybe a 10 year and get 4.3, get the same and lock it in. I'm just kind of wondering, I guess as a consumer, why in the hell would anyone want to buy right now the 2 or the 3 or the 5?
Oh yeah, and I wouldn't imagine there's a lot of demand there right now. But this gets back to what we've been talking about since I started working with OTA. The yield curve is a graphic representation of where interest rates are today. It's a great snapshot, but it's also a forecasting tool.
Right.
That inversion that you see developing between 6 months and 3 years, and that low point at 3 to 5 years, which we call the belly of the curve, that is forecasting upcoming rate cuts. That's literally saying starting in 6 months, we're going to see the Fed start cutting short-term rates, and the market is looking for rates to cut for the next 2 years. So again, that doesn't mean the market's going to be right? Remember, we did 18 months of an inverted yield curve and never got the recession that was calling for. So I'm not saying the market is always right, but the yield curve is a forecasting tool.
So in essence, what you're
and that's
saying,
what it's telling us.
Yeah, when I look out here, and I'll put my cursor for the audience on the 3 year right there, what you're saying is that 3 years out, the market is anticipating that the short term, the 1 month, will be much lower than 3.8.
Correct.
Wow,
Correct.
Interesting.
That's exactly. Yeah, that's looking at the forwards curve as a forecasting tool.
Pretty.
And yeah,
wild
so
stuff.
The marketplace is pricing in cuts, just like our equity investors are, hoping for cuts.
Well, if you got a long-term portfolio, there's no reason not to be cheering for cuts, right? You wanted that little juice for the market to pop it up.
Absolutely. And talking about politics and all of that, I'd be remiss if we didn't talk about. Did you see Governor Waller's comments today?
Yes.
Talking about we should be cutting in July.
I saw that. I was like, well, that's interesting. So just for the viewers, let's bring up the probability for the month of July. Of course, that meeting will be July 30th, and you can see right now there's an 83% chance we're going to keep rates exactly where they're at, only a 16% chance of a rate cut. And that's been oscillating over the past month. So that's really no big news. Maybe that hasn't quite priced in Waller's comments. We'll see what happens on Monday. But going back to the table, which you didn't get to see, Bill, but the data well.
Yes, please. I love that you were explaining that to me. Thank you.
The data does pose the argument. I guess we need to flip the argument. The argument is why he should keep rates the same, right? That's what it has been. It's like, and I've been one of those aggressively saying, stay the same. Just let all these things filter through, give it some time. Now I'm in that camp of, look, dude, you said you're data dependent and everything is pointing at it. What are the arguments for him not to, other than the tariff and maybe Israel conflict?
I would make the argument it's much like looking at an earnings from a corporation. The snapshots we're looking at the economy are what happened in the past. Mm-hmm. It's yesterday's news, right? I mean, we're working now off April's numbers. We're starting to get May numbers in now, but that's backward looking. What Powell is saying is forward looking. We're worried on the horizon about this tariff situation. It's a matter of which way is your focus.
Yeah. I guess
I could have a great quarter last quarter. That doesn't necessarily mean I'm going to have a great quarter next quarter.
That's true.
So I really do think it's the overhanging of this tariff situation is what's causing the problem. And I also want to point out, because I've had a couple of classes, been involved with OTA a good amount in the last 2 weeks, and a lot of the comments I hear though is, and I think I've gotten in almost every session I've had with you guys, is, well, Europe's cutting, UK's cutting. Why doesn't the U.S. cut? Like it's a popularity contest.
Keep up with the Joneses, Bill. We got to keep up with the Joneses.
Yeah, exactly. I said in one class, it's like my mother used to tell me when I was a little kid, I don't care what the neighbor's kids do. You can't do it. I don't care what the neighbor feds do. We can't do it. But I just want to address that because I think Powell's getting a little slander there by saying he's going to be too slow, too late. Again, he's looking forward. The data is looking backwards. But, excuse me. I'm sorry.
No worries.
I'm talking too much this week.
I'll real quickly, while you catch your breath over there, let me show you here just so you can reiterate what he's talking about. So not all banks are cutting. So here is the Bank of England, which of course had a rate announcement last week, and they decided to keep things the same. And they have been aggressively cutting. They were up at 5.25, and now they're at 4.25. So they've stair-stepped down. You look at the one this one was kind of shocking to me, was a Swiss National Bank. So they were up at 1.75 back in December of 2023, and they're at 0 now. That's unique. Now let's not freak out about it because remember they were negative for quite some time. They were negative 50 or 75 basis points. So not that concerning, but getting towards that zero line is always interesting for our markets. Of course, here is the United States, where you can see we've been plateaued and going sideways for 5 meetings now, which fine. I think that's the prudent thing to do. Let's see, Bank of Japan. Well, they're a mess, but
right.
It's funny because
there's a hike in there.
Yeah, I saw definitively people going, well, Japan, everyone is cutting rates. I'm like, 3 letters, JPY. No, Japan. Right. Japan has actually been raising rates. Now they've held for 4 consecutive meetings. Were there any other noteworthy ones here from central bank perspectives? Bank of Canada. So Bank of Canada has been 3 meetings in a row. They've paused, but remember they were at 5%. And now they're at 2.75. And lastly, before I bore my audience to death, we'll go to the ECB, which was at one point 4.5%. Now they're at 2.15, and they have been aggressively cutting every single meeting. I think that's what most people are pointing at, is saying, well, the Europeans are doing it. Well, we better cut. And, a lot of times, I think that, and I apologize, but I think Trump can be a whiny little baby at times. However, I think you're kind of looking at it going, Trump might have a point here, like, cut rates, dude, cut rates.
Well, but here's where I just want to throw a bit of a flag on that, because every economy has to respond to its own native situation. If we look at the European Union right now, 7 of those countries are presently at negative GDP. They're probably in a recession right now. So, for Europe to be cutting rates with 7 of their countries potentially in a recession makes a heck of a lot of sense. That's not our situation. Our GDP is up over 1%. So, I don't mean this as callous as it's going to sound. I don't care what the neighbors are doing.
Yeah.
They're responding to their own situation. I mean, Turkey raised rates. Does that mean we should be raising? Right. So.
Well, it's cannon fodder. It's cannon fodder for the politicians, right? Because, if you're a president and you want your rate cuts, you will see what they're doing and see what they're doing, But in that case, you're not the parent, you're the kid, though. Like, see, he let Timmy got a motorcycle for his birthday. Why don't I get one?
They got a rate cut. How come we didn't? Well, they're in a recession with negative GDP. We're plugging along at 1.5%. We're in a very different situation.
Right.
And let's also be honest, this whole tariff topic is really going to focus on the U.S. more than any other country, since we're the prognosticators here. So, the tariff situation, although it's going to have the impact to the world, is most directly going to impact us. So I understand why Powell is not anxious to make moves right before this the tariff situation. I really do. Personally, I'm willing to cut him a little slack. We've been at status quo for 5 meetings. Another meeting or two isn't going to kill us.
Yeah. You know what? I'm kind of thinking that this is theater. Now, just hear me out.
Yep.
Jerome Powell certainly doesn't want to leave next year with this really bad legacy. So I'm thinking you hold out as long as possible. It's like a blockbuster movie, and you know you have to end the movie at 11 o'clock. So you string your audience along until like that last 15 minutes where you make their jaws hit the floor. Maybe what we're getting here is Powell just saying, hold, like William Wallace, hold, and like right as he ends his term, rate cut, and just juice this market, and he goes, see what I did, folks.
How stupid am I now?
Yeah.
Yeah. And maybe, I think all politicians worry about their legacy a little bit. But I really think he doesn't want to be accused of acting premature in front of the tariffs. I really do. I'm being redundant, but I really strongly believe that.
Well, I mean, the future is always unwritten. We don't know exactly which way it's going to go, and things change over time. We shall see. I think I'm in the camp of data dependent, and that's why I created that little spreadsheet. For the rest of the year, for those who want to know what the year holds, here is your calendar for that. Right now, there's a 41% chance of 2 rate cuts by the end of the year, and it's a pretty even distribution there, although slightly higher, 28%, that we actually would get 3 rate cuts by the end of the year. 22% we get 1. So pretty sure rates will not stay the same. I guess I have to put you on the spot, as mean as I can be. I remember earlier this year you were saying, I think we might get a rate increase this year. Have you changed your mind?
No.
Oh
no, I still think that is, again, I keep coming back to this tariff is real. The tariff situation is really, I think, going to be a game changer. I mean, we're already seeing some positives from it. We got tariff income coming in. We're not as close to the debt ceiling as we were. So we're even, I don't mean this is all negative. There's actually been some positive news on that front. But I really do believe in my soul, and I'm not a modern monetary theorist. I'm an old Keynesian. I really, in my soul, believe that tariffs are inflationary. And in spite of what the president might say to businesses about absorbing it and don't pass it on, let's be honest, they're going to pass it on.
yeah.
I do worry about the stagflation discussion. That's the boogeyman that's still hanging out there, is that old stagflation discussion. Without a clear direction as to where the economy is, you throw in a potential game changer like rising inflation due to this tariff manipulation. Yeah, you can economically justify perhaps a rate increase. Again, I'm not as calling for that as much because it seems like it's taking forever. Number one, we don't know what we're dealing with. And number two, we just haven't seen the impact yet. How can we respond to something that has never happened before?
Agreed. Yeah.
We can guess, we can make assumptions, we can do modeling, but bottom line, this is a pretty big game changer. And I don't know the impact, nobody does, what the impact is to the U.S. economy. And I guess this is where my pessimism comes out again. I do forever worry about inflation. I guess that's the issue.
It's all right. It's not a bad thing. It's okay to be. I guess, as someone who has seen it happen to such extremes in the past, that, you should have that memory etched in your mind.
I do. When the Fed was raising rates 100 basis points at a time or 700 basis points in one meeting, that's my frame of experience. Yeah. Things can turn quickly. We went from 6% inflation in 1978 to 21% in 1981. It only took us 2 years to get that level of inflation come into the market. If and when inflation roars, it roars big. Mm-hmm. So I don't blame Powell for being a little bit cautious in front of this.
For those that were asking, July 9th is when the pause on reciprocal tariffs will end, and who knows what will be the outcome there. We've heard Scott Bessent say very clearly, look, if you're negotiating with America, then we will continue the pause. If you're not, then we will immediately remove that pause and start tariffing you right away, which, hey, right, fine. I'm fine with that. You should be at the table talking at this point.
Right.
You look at it, that's that vertical blue line that you see on your screen July 9th. I would expect, personally, there to be a down move around that, because I don't think that everything is going to be rosy. And given President Trump's historical track record of, let's make a deal or not, I think you'll get some heavy-handed rhetoric around that moment in time, therefore causing the markets to have a little bit of panic. But, the trend looks phenomenal at this moment in time. Yeah. And I think all-time highs are right around the corner.
That's what the market is telling us. Again, optimism is creeping into my psyche, and I'm not comfortable with it.
Let me ask you real quick not a bizarre question. I guess it's a very timely question. And you had mentioned in the past, Bitcoin, not a big fan because I don't see it having much utility. It doesn't really make too much sense there. The Genius Act recently passed this week. Was it this week? Yeah, this week.
Yeah,
and
and
that's, in my opinion, I don't know if monumental is the right word, but it is certainly something that is huge for the markets. I'm curious to get your take on it, or if you're not so familiar with it, maybe I can fill you in some holes. But what's your take on the Genius Act and what it means? Because this does impact the bond market.
Yeah, and I'm not going to lie to you, Merlin. If there were highlights you think I should respond to, I'm not that familiar. I am curious, though. I have been reading peripherally, what's going on. Why hasn't the cryptocurrencies responded more to the passage of that?
It's a great question. And I think that it was kind of a buy the rumor, sell the news. If you look at the company that was at the forefront of that, Circle, we've been talking about Circle, which has cost me a lot of money over the last couple of weeks because I've been shorting it. This is an issuer of stable coins, and I'll bring up the chart for the viewers out at home because this thing is just unbelievable. This is one that you'll be talking about. This is the talk for the ages kind of chart. Their initial IPO price was supposed to be $28. Then they jumped it to $31, and now it's trading at $244 per share. It's up another 20% today. It was up 33% yesterday. And if you look at the fundamentals and numbers, it absolutely makes no sense whatsoever. Anyway, they issue stablecoins. And I guess in a nutshell, the reason I was asking this question is the rule in the Genius Act, the rules will clarify that in order to be an issuer of a stablecoin, which means every bank in America can now issue a stablecoin because they'll get the permits or the permission to do so. But every dollar that gets purchased of the stablecoin will have a percentage that goes into cash, right, in savings accounts, which means it's holding U.S. dollars. Another slice of that pie will be going into short-term treasuries, 1 month, 2 months. My guess is maybe 3 months, somewhere in there. And then another portion could be for the repo market. So, in essence, in my opinion, what happens is the government has now created the perfect advocate for them because you're buying cash, which supports the U.S. dollar. You're buying short-term treasuries, which now you've got a buyer guaranteed lined up. So if stablecoin usage surges, you've got more and more buyers of your treasuries. That means you can drop your yields even more because you got so much more demand. And you got someone to participate in the repo market so you can remove liquidity when you want. I mean, it seems like an absolute win-win for the government with stablecoins.
I absolutely agree. I will also say, my concern about the cryptocurrencies up to this point is at this point, they haven't come through with the currency side of the equation. They're not a currency.
Right.
They're just not. They're not used as a medium of exchange. Yeah, you can sell your Bitcoin to buy something else, but hell, I can do that with my comic book collection. That doesn't make it a currency. So I think the crypto market has greatly underdelivered on the currency side. And that's what I was looking forward to most. That's what we were sold. Was the idea of, you take your Bitcoin ATM card and you can use it throughout the world. No more exchange rates. I mean, I was looking forward to that. And needless to say, that hasn't happened. But I think the application of crypto in a currency is best utilized in the stable coin. This could take care of my concern about crypto not being the currency that I think it could or should be. So I'm all in favor of it. And as you say, as a bond guy, the fact that all these stablecoin issuers are going to be holding collateral in the form of treasuries, anything we can do to increase the demand for treasuries, I'm in favor of.
Yeah, and that this will be, a fixed buyer. And there's all this talk about the U.S. dollar losing its world reserve currency status. This, in my opinion, this goes much further than just domestic borders because now what you're getting is international companies are going to be accepting USDC because it's fast, it's digital, easy to move around, and that may further solidify the dollar as that world reserve currency. So it really just seemed like a win-win-win for me on many different fronts. But
I have to agree with you. And again, I'm still holding out the use of this asset as a currency, and I think stable coins are going to be the answer to that. I really do.
Yeah. Or once we get our central bank digital currency.
Well, yes.
Since we're there, since I saw your reaction, I need to know. What do you think? Are we going to get a central bank digital currency?
I think we should. I don't think we're going to. I don't think the government has the conviction or the political wherewithal to do that. And I also think, the fact that the central bank can then see every and all activity should be a bit concerning to people.
100%.
But yeah, right.
I'll be honest.
So,
I don't care if they see everything that I do with my money. What I am concerned with is the ability for them to literally hit a switch and go, Bill Addiss can no longer access any of this money. You are completely cut off. And if I worked for the government office, I'd be like, hey, you got an ex-boyfriend you don't like? Oh yeah, here, watch this. Bam.
Put him on the list.
We'll just do it for an hour.
Right. There's huge efficiencies to it. I mean, from a business point of view, I think it makes sense. I really do. Those 4 or 5 countries that have implemented it, nobody's pulled back. Everyone seems to be going forward. So I do think there's benefits to it. I just don't know if we have the political wherewithal to get it done.
Yeah. Yeah, and certainly there will be that portion of our population that will never want it because of the privacy violations. And I agree. I mean, they'll be able to see every single thing you do with your money. There's something nice about having a greenback and knowing I can do whatever I want with this, and no one's really watching me.
Exactly.
So
exactly.
I'm sure a lot of the nefarious actors out there going, oh no central bank digital currency. Go ahead.
The other thing I just want to point out quickly is, we're even starting to see, U.S. Treasuries getting converted into token form.
Yes.
It's interesting how the street is playing with this. So we're actually moving some of the bond trading onto distributed ledger technology and doing it also in meme form. So there's a lot of evolution going on the, blockchain technology, even just away from the coins. Wall Street has embraced the digital technology.
Yeah, watching Larry Fink's interview several months ago where he said, we are all in on tokenization. And I don't think I could be more adamant that any digital product today, anything that's digital or has a digital representation can be tokenized. And you're already seeing it with JP Morgan, right? They started with their Onyx blockchain, and then they moved over to Connexus, and now they're connecting banks to that to tokenize the money market, money transfers. You're going to have housing, real estate, cars, all these assets will be tokenized, but things like bonds, right? It is a little challenging to buy bonds. I can now just hit a button, I get the token and the yield paid directly to me. I mean, it's a much more efficient upgrade to our systems.
It solves huge operational efficiencies. Absolutely. I'm all in favor of it because it makes it operationally so efficient. I mean, right now we're settling over $2 trillion a day in the repo market using tokens and distributed ledger technology. So I'm all in. Believe me, on the technology, I am all in.
And it's really like finding the larger projects that will be the infrastructure that these guys are building that tokenization on top of. Solana has been a very key one for that, and there'll be others that pop up. Indigo says, "Is the USD at risk?" No, the argument I'm just making is this actually makes a stronger case for the US dollar because now all the stable coins that are okayed and permitted by the US government, which there will be a permit process to become a stable coin, that stable coin has to, by law, audited, have US dollars in cash, holding it in a bank, and also be buying bonds. So the government's, like I say, this is a win-win for the government. Somebody on Twitter today said, Merlin, if the government wins, it's always a loss for the people. And I said, in general, I would say you're probably right. In this case, it's a win-win because if you are involved with digital assets, this is a nod from the government that this industry is here to stay. It's not like, we're going to turn it off and digital's going away. It's here to stay. It's now, how does it evolve? How does it progress? How does the government control those market factors and move? But this just makes further strength for the US dollar.
And if I could just follow up, because I remember, and I'm not going to remember the name of the stable coin, but about 3 or 4 years ago, we had those 2 stable coins that ran into trouble.
Yeah.
And they were supposedly backed, but when we look at the fine print, the backing was actually in the form of bi-party derivatives contracts. There was no real asset to that. I assume and hope that in this legislation, derivatives are not a viable collateral source, that it actually has to be cash and or treasuries or something like that.
Yep. So, and that's specifically, it's what I've been talking about in my crypto program for months is all we want is clarity here because you have Tether, which is in all kinds of stuff. Like we really don't know what it's in. Great question. So Dwight says, what does tokenization mean? Let me get to that in a second. Indigo says, what's the leverage amount and what can happen if they fail? There is no leverage allowed in these funds. So essentially what happens is Circle will take in, let's say, $100 billion in dollars. A portion of that, which has not been specified, let's call it 25%, has to be in cash, right? I'm making up these numbers, but 25% has to be in cash. So they've received $100 billion. $25 billion of that will stay in cash, and that will go into a variety of registered federal banks and will be an audited deposit. Now you've got $75 billion left. What do you do with that? They will now start buying 1-month treasuries, and they'll be getting 4.3% per month, 4.3% on that $75 billion. That's how they make their money. It's really what you guys should be doing with your money, which is buying those bonds and getting that 4.3% for yourself. They're doing it, taking a slice of that pie and giving you a little bit of extra back. So it's designed to be pegged to the US dollars, but no, it's actually great for the dollar. Fantastic. And there is no leverage. They can't take in $100 billion of customer funds and say we're buying $200 billion worth of bonds. That can't happen. And that was the big concern with the Genius Act, is they wanted to make sure that the American taxpayer is not going to be on the hook and get, ruined by these stable coins.
And forgive my ignorance, who's going to regulate this under the Genius Act?
Great thing. I did not see who was supposed to regulate it or if it's going to be a new division created for this one. I did not see that. But there will be regulators and it will be audited on a monthly basis. And Circle, to be fair, is already, you can go to their website right now and they have, by Deloitte, is auditing them every month and making sure that the money is in a bank account, that they do have bonds, and that they're accessing the repo market. So is it 100% risk-free? No. Is it about as safe as you can get? Yeah. Your cash and your government bonds. So safe. Margaret says, who's going to manage it? Hunter Biden. I don't think he'll be managing that one. You guys are good.
They are good. You got a creative audience.
Yeah, we do. They're skeptical like I am. Let's see. There was one other one I want to go to. Dwight, I'll get to tokenization in just a second. I want to wrap up with Bill here because it's a Friday. I know he's got a happy hour somewhere because on the East Coast he's already 3 hours ahead of me, so I don't want to interrupt your happy hour. Tell me a little bit.
I'm here for whatever you want.
Tell me a little about your upcoming schedule. I know you're doing the Canary in a Coal Mine bonds class for Trading Academy. What other things do you have on your plate?
Yeah, the next XLT I'm going to do is July 18th. I do one of those a month, and we're going to get into the muni market. Back in April, when credit spreads really blew out on corporates and high yield and on mortgages and munis, the rest of the market has kind of consolidated back in. The credit spread on corporates again is horrible again after being really wider about in April. But the muni market has maintained that wideness. These credit spreads in the muni market remain relatively attractive. So we're going to get back into the world of tax-free income with the audience on June 18th. And I apologize. We just had a focus class, so I'm not sure when the next one is. It'll probably be the end of July. I apologize. You can check the calendar for that. But we run those about every 6 weeks. So
no apologizing, Bill. Here's your calendar. For those of you who are Trading Academy graduates, log into my OTA. You just go to the calendar, type in Addiss, and you can see here. This is his last piece for the month. He's got all next week off. I'm sure he's teaching for Goldman or the Fed or something. In July, let's see, July loads up here. So the next, the full focus class for Bill will not be July. It'll probably be August. But he's got an XLT general session on the. Are you doing the XLT general session on the 23rd? Did you ever get that switched? I know you wanted to switch with me.
Yes. I moved to the 18th.
Okay, perfect. Good.
Yes, so I'm a little bit earlier in the month than usual.
Sounds good. And then you can see his Canary in the Coal Mine application sessions are Friday at 11 a.m. So he's done for the day.
Yep. I'm going to throw one last topic out if I could, just to throw something on the wall that I wanted to make sure we covered. And that's the topic of the tapering.
Yes.
The Fed is continuing to destroy money. And I have to say, they've been very quiet about it. You don't hear even the talking heads. But if we look, you and I talked about the Fed's exploding balance sheet up to $9 trillion. And as of last week, the Fed now has a balance sheet of less than 7. Mm-hmm. They have successfully destroyed $2 trillion over the last year and a half. So the tapering goes on, and it's pulling liquidity out of the market, which is what we need long term. But you don't hear the talking heads talk about it much, so I thought I'd just throw it out there. So they started at the peak of 120 billion a month. We're now down to 30 billion a month, but it's adding up. A billion here, a billion there, it adds up, and suddenly the Fed's balance sheet is under $7 trillion.
Yeah, I've got the chart up here, which is impressive. And, the talk track, the words that Bill likes to use is soft landing. I feel like Sesame Street. The word of the day is soft
Word of the
landing.
day.
If you look at the chart here, you're right. I have the full balance sheet going back into 2022. We're 8.9. I'll round up 9 trillion. And currently, as we stand today, it is 6.7 trillion, and the trend is going the right way. Good question from Steven. It says, what do they want to get it down to? My argument would be they want to get as low as possible before it starts to impact the market, right? I mean, is there a number?
And that's a great question. I get that question all the time. What is the magic number? There is no magic number. When the Fed sees that they can sop up liquidity by doing their repo market and clients are lining up to take advantage of that, that's an indication to the Fed that there's a lot of cash out there. Now, that repo market has dwindled down to about 500 billion a month. We were doing 2 trillion a night. So there is less cash out there. And I think the next thing that we could see is the Fed announcing that they're no longer going to be doing the repo with the insurance, banking, and money management industry because they don't need to sop up that cash anymore.
Mm-hmm.
So the Fed will kind of trigger to us, give us a clue when they think we're at an equilibrium point, when they discontinue that program they introduced during the pandemic. And they'll probably do that soon because the numbers have been going steadily down. There's just not as much cash out there, and that's good news.
It's great news. I mean, watching this, look, I mean, I've shown this chart to people, the M1 money supply going back into 1959, when it's just staggering how much was created.
500% increase in M1.
Unbelievable. Just mind-boggling. And now you're seeing that total assets go back, which is great. I'm not going to lie, my audience knows, I thought that this was going to create an absolute catastrophe. I thought this would have been one of the biggest market crashes since the Great Depression because you have just flooded the market with money. It's like the Weimar Republic again, and all of a sudden the money I have is not even worth wiping my butt with. It's that week. But we've been doing pretty good. I still am not going to give Powell his victory lap. I'm going to let you give it that one. I'm going to wait till the end of the year.
Where's the recession? We went 18 months of an inverted yield curve. Where's the recession? It never happened. Why isn't Powell allowed to take that victory lap?
All right.
They brought rates down to 0. They brought them up to 5.25. They dropped them down again.
I just can't believe that we're done.
Full cycle.
I just can't believe it.
We're never done.
It's just almost impossible to
We're
feel like
never
this
done.
is not going to, you print so much money, you completely manipulate the bond market, you completely manipulate mortgage-backed securities, you inflate the housing market to astronomically high levels, and there's no fallout from that? I mean, that's like saying I could mainline heroin for 7 years straight and just stop cold turkey and have no problem. It's not going to happen. I'll probably die in the process.
Well, and I think your point is well taken, and I think that's the reason they're being so quiet about the tapering, to be honest with you. Remember when Bernanke first used the word tapering back in 2018 and the equity markets suffered the tapering tantrum?
Mm-hmm.
I think the Fed is honestly being kind of quiet about this because they don't want to raise that specter. Because you're right. I mean, let's admit it. All this cash that was flooded into our economy was the adrenaline we all lived off of coming out of the pandemic.
Yeah, absolutely.
And now they're cutting off that adrenaline supply. So, no, I don't disagree with you, but I do think that Powell gets to take a victory lap. He inverted the yield curve. We did the quantitative easing. We're now doing the tapering. 18 months of an inverted and no recession. First time in history. First time in history.
Fine, he can have his victory lap. Fine.
You think I'm a paid political spokesman for
No, you're right.
Powell at this point? I feel like it.
No, hey, I mean, I sure as heck wouldn't want his job. I'm sure a lot of people would, we can all point fingers and go, what a loser, you should have done better, you numbskull, whatever Trump called him today. It's like, I disagree. He's not a numbskull. He's a very smart guy, and he's, when you and I have to make decisions on what to do with our disposable income, like do I buy a car, do I do an improvement in my home? This guy's decisions change every single person's life in a way. So that's a pretty big responsibility.
Yep. No, I agree.
One quick question from Margaret. I know we meant to wrap up, but I think this would be good for everyone.
Go ahead.
What's the mechanics of tapering? All right. So because everyone hears it, and I think some know the basics, but what would you say would be the mechanics of tapering? What actually is happening?
Sure. And to do that, I first have to do easing real quick. So when we talk about the Fed, we have to remember that the Fed is responsible for money supply here in the U.S. The Fed creates and destroys money, not the government. The government doesn't do it. And the Fed has unlimited authority. So during the pandemic, our Fed, literally with a push of a button, was injecting $13 billion a day in cash into the US economy. Because what the Fed was doing is, during the pandemic, is they were buying $13 billion a day of treasuries with money they were just creating. Now, you got to remember, kind of tangent on our conversation earlier, money in today's society is virtual. Right? And 96% of our cash in circulation is virtual money. Only 4% is represented by the bills and coins we walk around with. So when I say we're creating and destroying money, we're doing it virtually. So during the summer, the Fed was going into the dealers in New York. They were buying treasuries. And when they had to pay for those treasuries the next day, so let's say the Fed bought 5 million in treasuries from Citibank. The next day, the Fed's got to pay $5 million for those treasuries. Because they're the Fed, literally with a push of a button, the Fed is crediting Citibank with $5 million of cash, virtual, that literally didn't exist the nanosecond before. So literally think of it like the pandemic. There's the Fed all day, just pushing the button, paying for all these treasuries they're buying and injecting all this cash into the US economy.
Right.
Now they're doing exactly the opposite. So here's the Fed sitting on this, let's call it $7 trillion portfolio. And this is the largest bond portfolio in the world. And it's receiving a huge amount of interest every month. You know, when the government pays their interest on their treasuries, most of that money goes to the Fed because they've got the largest holdings of treasuries. So what the Fed is doing is, once again, as that money is hitting their account, literally with a push of a button, they're destroying that money. It's ceasing to exist.
Yeah, just removing the digital
ledger. It's removing the digital ledger perfectly. But I do have to remind your audience, this is kind of frustrating to us, the taxpayers, because remember, the government doesn't have this money to pay all the interest. So here's the government is going out and issuing all these treasuries because they have to pay all this interest, $1 trillion a year now. Then they turn around and pay a lot of that interest to the Fed, who then literally turns around and destroys that money. The money the government had just borrowed, the Fed turns around and destroys it. How's that for a screwy loop?
It's definitely a very screwy loop. And it's one that we're stuck in the middle of. It's one that I think no matter whether you might hate it, it's been a piece that helps save the economy. And if we didn't have that sort of quantitative easing, our markets would have been in a very different place. We would have had a much harder fall. I am a believer, like John O'Donnell, that you should let the markets heal themselves. In this case, we've artificially manipulated it. If it was a medical example, lots and lots and lots and lots of drugs were being pumped into this economy to keep it going where it needed to go, or at least where they felt they needed to go. And now you're weaning yourself off of what you pushed into that system. So, and so far it's working okay. Yeah, doesn't seem too bad. Yep. All right, last one before I let you run, and this one I know you know the answer to, and I have no idea on this one. This is Big Ab. Okay. He says, Bill, what is the dollar amount benefit is there for every 1/4 point cut with regards to national debt interest? I know you know this one.
Well, the number I know off the top of my head is every 1% rise in interest rates results in the government having to pay an extra $250 million in interest expense. God. So the cut would be, it's binary. So the cut would go the other way. So for every 1% cut we put to the market, there's a $250 million savings on that.
Yeah. Which would be, at 1/4%, Big Eb, you're looking at about $60 million.
Yeah.
That's crazy. Crazy spending. Yep. All right, Bill, well, thank you very much.
Particularly when you consider the Fed then turns around and destroys a lot of that money.
It's just this giant, it feels like a money Ponzi scheme. It's just this shell game, like 3-card money with the government. Like, oh, you pick the cards here. No, it's actually under this one.
Government financing is a Ponzi scheme, Merlin. The reason we're issuing treasuries is because we don't have the money to pay off the ones that are maturing this week, right?
Yes, right. There you go.
So we have to issue more treasuries to new investors. We borrow from Peter to pay Paul. That's a Ponzi scheme. Yeah. That's what government financing is these days when you're in deficit financing. That's exactly what it is.
Was that 1% savings in per month or per day? Or
no, if interest rates drop by 100 basis points, it's $250 million a year.
A year? Oh, that's not that bad. Right. Oh, that's
you sound like a politician.
Oh
100
man,
million here, 100 million there.
That's an apartment for LeBron James. I mean, come on, big deal. All right, hey, well, thank you very much. I appreciate it. As always, if you guys would like to know more, you can obviously visit Trading Academy. You can click on my OTA, find out his calendar there. You can see his XLTs. You can see his focus course as well. If you would like to see some other videos, he's got them over here on his aftraining.co. And you click on the media page here, there's a bunch of videos he's done. He's also got some books that he's written and been a part of that you can buy. The book series, which I have a copy of. They're fantastic. You can buy them as well. And discount for buying all the. Don't buy individual, buy all 3 books.
That's right. Buy the set.
Buy the set. That's the way to go. All right, Bill. Hey, thank you so much. I appreciate it. Thanks for coming on and sharing some insights. Have a fantastic weekend and good luck on your road trip.
And thank you. And you enjoy the Money Show in Vegas next month. I'm proud of you.
Swing by and say hi. You owe me some beer. Vegas is right there.
I know. It's just a mere plane ride away.
It is.
We're up to 3 beers, and I'll owe you more. I'm sure.
Oh, I'm sure of it. All right, buddy. Take care. Thank you so much.
Bye-bye. Be well, my friend. Take it easy to everybody. Bye now.
Because that was Bill Addiss, my bond king, giving us some insights as to what the bond market is doing, where it might be headed. God, it just makes you feel optimistic on the market. It really does. Kind of crazy to be that optimistic on these markets. It is what it is. All right. I don't even have enough time. I'm just going to show you. I don't know why I'm yelling. I've had headphones in, so I sound really weird right now in my studio. The circle chart, yeah, I'm as many of you getting absolutely smoked on those puts on circle, and I have $1,000 left to play with because I told you I had a $7,000 limit. I'm not done yet. I have the July 120s. These are all gone now. But my goodness, what a ridiculous chart. And again, I believe a lot of this has to do with just 18% of the shares are on the market. The other 82% are behind the scenes waiting to be sold and unlocked. So that is the wild one. It was a pretty crazy move today in crypto. It was looking great. We're up at 106 and then all of a sudden just came screaming back down. That 5-minute chart of Bitcoin was like, uh-oh, what's going on here? This does not look good. I'd much rather the one that we had in the late hours last night, right after midnight, when it just kept on rallying and rallying and rallying. But Toby says, I gave up puts and started selling them. Oh my goodness, bud, be careful. Tofi, be careful. I don't want to see you get smoked. Because that thing has the ability to drop 100 points in a day. 100 points. It's absolutely nuts. And as John Maynard Keynes said, it's one of the truest statements in all of trading. The markets can remain irrational longer than you can remain solvent, which is why I have told myself, here's how much money I'm going to spend on this circle altogether. I may lose it all. Just unpredictability of the market is absolutely crazy what's going on. That thing is only worth $30. Remember, they said 28. They upped it to 31 in their IPO. That's what it's worth. And I think the Genius Act has people just running as fast as they can to buy some. If you look at the after hours too on Circle, let's go CRCL. Look at that. Look at the chart here. I mean, just especially what happened yesterday. We were down at $150. It closed the day at 203 and then opened up the next morning at 230. Just ridiculous. Okay, Tofi, good. Yeah, please, guys, be careful of that thing. I mentioned on yesterday's show, I'd hate for you guys to short it outright because it has infinite risk. Euphoria can continue to drive this thing up higher and higher and higher and higher. It doesn't make sense at this point. I can tell you that the stock is not worth $240 as it is right now. There's no calculation you could possibly give me that would tell you that this stock is worth $243 per share. But it could go to 280, 290, $500 by next week. Who knows? It will crash. And I'll hopefully have some skin in the game when that one does crash. But the way my profits were wiped out this last 2 trades, not looking so good. But I do have until the July 18th expiration. But my expiration is 120. I have a feeling I might actually make money on that one, but probably not a lot. Anyway, wild market. Other than that, we just had spinning tops for the broader markets. Here is the S&P, which had, spinning top really unchanged pretty much on the day. Wild stuff. But it's hard to time value investing. Absolutely. So I will be put 3 different things. Let me bring up the charts. So I will be selling, we'll see what happens on Monday, but we had UNH. So remember, I had the 305 strikes for UNH, so I will now be long some UNH. I have MicroStrategy at 375, so I'll have and 400. So I now have a pretty decent sized position in MicroStrategy. That'll be 600 shares long. And we'll see what happens over the weekend. It's not looking good. This may actually end up being a dump it if it drops below 360. 350. So yeah, make me a little nervous here on this one, but for now, I'll hold it. We'll see how this one goes. But yeah, it's not looking so good position-wise for me. Will it break below some more? Possibly. Absolutely. Some money from Bitcoin to Circle, I believe. Maybe. I just think, it is so thinly, there's not a lot of shares. So when you create hysteria and people go to their, when people look at this filter right here and they go, show me the biggest gainers on the day, and go here and go percent change. Let's go short ascending. Oops, wrong way. Oh, well, at least it wasn't SLNM, which is up 2.4 million% today. And these look so great, right? When you see these numbers, a 2.4 million% gain for SLNM today, but there's 140 shares traded. Let's see what that chart looks like. It went from 0 to 2 cents. Wow, big deal. Okay, I want to show you. I have to do a whole bunch of stuff here, which I'm not going to take the time to do because I was going to wrap up the show. You have a buy order in for Bito? You're going for the futures product, huh? I would go with IBIT myself, but if you want to go with Bito, that's fine. What's the market cap on that for a stock that makes out 4.5% return? So you can probably go to here and see RCL. This is probably updated on TradingView. Do you want to look at the financials and market capitalization? It's $43 billion. $43 billion as of today's price. Nuts. These guys are loving it. Loving it. Okay, that's going to do it for me, everybody. We are at an hour show. I got to get my weekend going, so I went a little bit longer than I wanted to with Bill, but hey, good content. Let's keep it going. So hopefully you guys enjoyed Bill Addiss. If you want to know more information, you can find out his program, as I mentioned, by going to Trading Academy and looking at the calendar, typing in Bill Addiss, or just type in Addiss, or any instructor here, and they'll tell you what their upcoming schedule is. What does my schedule look like? Let me see. Let's go to Merlin, since there aren't too many Merlins on there. What's my schedule look like for Trading Academy? Oh, I got my next XLT general session will be on the 30th of July. Do I have anything next week? Just my crypto class. Oh, I have an XLT general session on Wednesday, and that will be digital assets and crypto. So if you guys are Trading Academy people, jump in there and heckle me. I'm sure we'll talk some of the things we've already discussed, but that'll be the XLT general session. All right, that's going to do it for me, everyone. I hope you enjoyed. I don't have anything to cheers you with, but cheers. Hope you guys have a great weekend. If you have any questions, you can email me. It's on the screen there, tradermerlin@gmail.com. I did put the link in the description. Should work for the Discord. I see you guys getting much more active there, so awesome. Thank you, and hopefully you guys enjoy that. And if you have specific questions in there, I think you can actually tag me in the Discord, and they'll come directly to me, and I'll answer those ones. So thank you guys so much. Have a fantastic weekend. Go do something fun, and I will see you guys on Monday. Hit the like, as Steven says, who's my #1 commenter for today. Thank you, Steven, and thank you, everybody. Tofi #2, Big Ed #3. I should have come up with little trophies and podium. Have a great weekend, everybody. I'll see you on Monday.